This is the revision of advanced audit and assurance for the exam period of March 2020. This is question 2. Fraud. If the full extent of the fraud is $40,000, then the audit team is correct to determine that the fraud is immaterial to the financial statement. However, without performing further procedures, it is not possible to reach that conclusion. There is no auditor-generated evidence to support the assertion that $40,000 is the total amount of stolen funds. Relying solely on the conversation between the group finance director and the manager who carried out the fraud and a list of invoices provided by the group finance director is not acceptable, as this evidence is not sufficiently reliable. Indeed, the group finance director could be involved with the fraud and is attempting to deceive the auditor and minimize the suspected scale of the fraud in order to deter further procedures being carried out or investigation or actions being taken. The auditor should approach the comments made by the group finance director with an attitude of professional skepticism, especially given that he has asked the audit team not to investigate further, which raised suspicion that he may be covering up the fact that the fraud was on a larger scale than has been made known to the auditor. There are two courses of action for auditor. First, further independent investigations should be carried out in order for the auditor to obtain sufficient and appropriate evidence relating to the amount of the fraud. This is particularly important given that the group finance director seems unwilling to make any judgment to the financial statements. If the fraud is actually more financially significant, the financial statement could be materially misstated. But without further audit evidence, the auditor can determine whether this is the case. Second, the auditor should consider whether reporting is necessary. ISA 240, the auditor's responsibility relating to fraud in the audit of financial statement, requires that when fraud has taken place, the auditors shall communicate these matters on a timely basis to the appropriate levels of management in order to inform those with a primary responsibility for the prevention and detection of fraud of matters relevant to their responsibilities. Given that the group finance director alerted the auditor to the fraud, it seems likely that management and those charged with governance are already aware of the fraud. However, the auditor should consider whether a formal written communication is needed. In addition to reporting to management and those charged with governance, ISA 240 requires that the auditor shall determine whether this is a responsibility to report the occurrence or suspicion to party outside the entity. The auditor's duty to maintain the confidentiality of client information makes such reporting potentially difficult, and the auditor may wish to take legal advice before reporting externally. 3. Audit evidence. Development costs. Given that development costs are material to group financial statement, more audit work should have been carried out to determine whether it is acceptable that all or some of the $600,000 should have been capitalized. There is a risk that research costs, which must be expensed, have not been distinguished from development costs, which can only be capitalized when certain criteria have been met. Currently, there is not sufficient appropriate audit evidence to conclude that the accounting treatment is appropriate, and intangible assets could be materially misstated. Agreement of amounts to invoice provides evidence of the value of expenditure, but does not provide sufficient appropriate evidence as to the nature of the expenditure. The procedure is not necessarily an evaluation of whether it is capital or revenue expenditure. Performing a arithmetic check on the spreadsheet just provides some evidence of the accuracy of the calculation, but does not provide sufficient appropriate evidence on the validity of projections. And in particular, there is no evidence that the assumptions are sound. Given that the group finance director has not allowed the audit team access to information supporting the spreadsheet and has refused to answer questions, he, he may have something to hide. The audit of the projection should be approached with a high degree of professional skepticism. The assumptions may not be sound and may contradict other audit evidence. The attitude and actions of the group finance director, which indicate a lack of integrity, should be discussed with the audit committee, as the audit committee should be in position to discuss the situation with him, with the objective of making all necessary information available to the audit team. Finally, there appears to be over-reliance on the written representation from management. ACCA 580 written representations state that written representations should be used to support other audit evidence and are not sufficient evidence on their own in this situation. It appears that the presentation is the only evidence which has been sound in regard to the likely success of the new product development, which is inappropriate. Further evidence should be obtained to distinguish between research costs and development costs, and to support whether the development costs meet the recognition criteria in IAS 38 intangible assets, and to confirm whether all of the $600,000 should be capitalized. Further evidence should be obtained, including a discussion with the project manager to obtain their view on the likely launch date for the new product, anticipated level of demand, any problems foreseen with completion of the project, a further review of a sample of the costs included in the $600,000, including evaluation of whether the costs are capital or revenue in nature. For example, cost review purchase invoices and ensure they are in the name of the company to confirm the rights and obligations, the assertion of the capital cost. Results of any market research to support the assertion that the new product will generate future economic benefits. A discussion with management to identify how they have incurred development costs without carrying out any research first. Assuming that the group finance director makes the supporting documentation, including assumptions, available to the audit team, the assumption should be reviewed for reasonableness, with the auditor considering whether they in line with business understanding and without other audit evidence obtained. Trade receivables. The trade receivable is material to the group financial statements, and currently there is not sufficient appropriate audit evidence to determine whether the amount should remain recognized within current assets. The group financial statement could be materially misstated if any necessary reduction in value is not recognized. Agreeing the balance to invoice and order forms may provide evidence of existence, but it does not provide evidence on the recoverability of the balance. including the balance owed by Hamlin Co. in the direct confirmation sample was appropriate, given the materiality of the amount involved, but again, this would not indicate the recoverability of the balance, even if Hamlin Co. had replied. So additional procedures would have always been required. Therefore, there does not appear to be appropriate audit evidence to confirm the valuation of trade receivables. Discussing the situation with credit controller will provide some relevant background information, but on its own, it is not sufficiently robust evidence to support the continued recognition of the balance. Further evidence should be obtained, including any written correspondence between the group and Hamlin Co. indicating the measures which the group has taken to attempt to recover the debt, and the response from Hamlin Co. Such public registers for evidence of whether Hamlin Co. has been placed in administration or receivership, example Companies House or equivalent. This will indicate the need for the impairment review if it is listed. Review the post-year-end cash received for any amounts received from Hamlin Co. B. Creating auditor's report. Uh, Headings and structures. The report should not have the opinion and basis for opinion combined in one paragraph. The report should start with the opinion paragraph, which is then followed by the basis for opinion. In addition to separating out the paragraphs, they should be given appropriate headings. According to ISA 705, modifications to the opinion in the independent auditor's report. When the opinion is modified, the heading should be used to denote the type of modification which is being made to the opinion. In this case, the title Qualified Opinion seems most appropriate. The basis for opinion paragraph should be headed Basis for Qualified Opinion. Qualified opinion. The qualified opinion paragraph should be worded differently. According to ISA 705, when the opinion is modified, the following wording should be used except for the effects of the matters described in the basis for qualified opinion section. The accompanying financial statement presents fairly in all material respects. The draft opinion paragraph used different wording, in particular using the phrase "the financial statements are likely to be materially misstated" does not indicate that a firm conclusion has been reached and could give users of the report some doubt as to the creditability of the auditor's opinion. Basis for qualified opinion. This paragraph should contain further information on the reasons for modification, including a description and quantification of the financial effects of material misstatement. In this case, the paragraph should refer to the overstatement of trade receivables of $450,000 and the overstatement of profit by the same amount. Currently, the paragraph refers to an overstatement of $500,000, which contradicts the conclusion based on audit evidence. Emphasis of matter paragraph. According to ISA 706, emphasis of matter paragraphs and other matter paragraphs in the independent auditor's report. And emphasis of matter paragraph is used when the auditor considers it necessary to draw users' attention to a matter which is of such importance that it is fundamental to users' understanding of the financial statements. The matter discussed in the EOM paragraph should be properly presented and disclosed in the financial statement. The draft auditor's report includes an EOM, which is being used to discuss two matters, neither of which are appropriate to inclusion in an EOM. First, the EOM describes the fraud which has taken place during the year. This matter is immaterial in monetary terms and therefore is not likely to be considered to be fundamental to users' understanding of the financial statements. In addition, it is not professional to highlight illegal activities in this way and could increase the risk of litigation from the group, as this amounts to be a breach of confidentiality. Secondly, the EOM refers to difficulties encountered in the audit of trade receivable due to the group finance director refusing to allow full access to necessary sources of evidence. This matter should not be reported to shareholders in the auditor's report. The appropriate methods of reporting is to those charged with governance approval as required by ISA 260 communication with those charged with governance. ISA 260 requires the auditor to communicate to those charged with governance regarding a range of matters, including significant difficulties, if any, encountered during the audit. Related to this, stating that it is the group finance director personally who is responsible for the material misstatement and hence the modification of the auditor's opinion is not professional and could raise further legal problems. For example, the group finance director could accuse the audit firm of making false statements of defamation of character. In addition, referring to the potential resignation of the audit firm anywhere in the auditor's report is not appropriate. This matter should be discussed with those charged with governance, who will then take the matter up with the group shareholders.